every currency is collapsing concurrently against precious metals. I would definitely buy some physical gold and have in your possession, say around 5% of your assets as a starting point.
Please join us for our next live stream, Sunday, May 31st at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, May 31st, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Michael Pento is back with us today on SBTV. Michael is the president and founder of Pento Portfolio Strategies. He is a well-known money manager and the author of the book titled The Coming Bond Market Collapse, How to Survive the Demise of the U.S. Debt Market. You've no doubt seen Michael making the rounds on various channels, and that's because Michael is one of the guys everyone wants to hear from. He clearly sees what a lot of us do not. And if you are new to this channel, please don't forget to subscribe, click on the bell to be notified of new updates, and do give us a thumbs up if you like what we do. We really do appreciate your support. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
Thanks for having me back on, Patrick.
Thank you. Thanks for coming back on. We've seen you all over the place nowadays. You're a very, very busy guy.
Well, you won't see me on CNBS or any of the mainstream financial television because they threw me off. They don't want me on there any longer. I'm a nice person, right? I'm fair. I treat people with respect, I think. I don't know why I'm not. I guess, if you call the central bank of the United States or any central banker a counterfeiter, which is what they are, you get thrown off TV. I don't understand. But you know what? I get on shows like yours, which have more audience, a larger audience, a bigger audience than any of the ones on television. And I get to actually talk and make a cogent point and expound upon it. So good. I'm glad to be with you instead of the halftime show. Scott.
Yeah, well, their loss is our gain for sure. So we appreciate you coming back. Michael, last time we spoke back in July, world has changed since then. Last time we spoke, July of 2019. Many countries have locked down their borders. Aviation and tourism industries are decimated, and we're still counting the damage in the real economy with businesses closed, jobs lost. And I want to start by asking you if you have seen anything like this before, and what are your thoughts on how quickly the world has changed in 2020?
Well, I mean, no one has ever seen anything close to this, Patrick. I mean, even in the Great Depression, it took many, many months for the decline in GDP to occur. We've seen a decline in GDP. I think the unemployment, let's just talk about the unemployment rate. I think the unemployment rate is very close to, well, I don't think so. I know it's close to 20%. It didn't take days for that to happen or weeks for that to happen in the Great Depression. It took many, many months for it to get there. So if you look at the latest unemployment rate that came out of the BLS, they said it was, I believe it was 14.9% or something like that. Then if you read the fine print on their site, I mean, this is not like a forensic accounting of their release. On their site, they say, I'll paraphrase this, if the people that said that they were unemployed and not looking for work were actually unemployed and still looking for work, then the unemployment rate would be 5 percentage points higher, or 19%. That's right from their website. So we have a 19% unemployment rate from, in the 3s to 19 in a record amount of time. So we've never seen anything like this. We've never seen the stock market go down, 30% in a matter of days. Never before. Now, we recovered a lot. It happened to be coincidentally on the day that the Fed announced that they were going to buy corporate bonds and corporate bond ETFs. Oh, gee, well, the high yield market recovered, the investment grade market recovered, and the stock market recovered. On that, just to the day, that's where the market bottomed. So, it isn't much of a mystery why stocks have recovered vis-a-vis the real economy. The real economy is still in a depression. I predicted that in early, I was one of the first people to call it a depression in February. I said, we're headed for a depression. It's going to be a depression. You're going to see numbers like we've never seen before. If you look at all the manufacturing surveys, you look at the data from the BLS, look at the data even from the Atlanta Fed, come out with a GDP forecast. We've never seen drops and as fast or as significant as we're seeing in the economic data. And you have to ask, well, how fast is that going to recover? That depends on the virus, Patrick. In my view, the governments of the world didn't shut down the economy. They shut it down because of the virus. So they can't open up the economy. If you see the virus make a rebound in June and July after the government say, hey, go out and enjoy yourself, have some fun. And people say, I don't want to go out. I'm not going to fly on an airplane. I'm not going to go gambling in a casino. I'm not going to stay in a hotel. I'm not going to go to a restaurant and try to eat a sandwich with my mask on my face. I can't do that. So I'm going to stay home. And the people that do go out, they start to see a resurgence of the virus, God forbid. Well, the virus is going to determine how fast the economy rebounds. And until you have, and I know I got in trouble last time for saying this, until you have a viable vaccine, and before I get a million emails about how could you say the word vaccine, because I was on another show and I got excoriated for saying vaccine. I'm not quite sure why I did, but maybe I could tell you this. The Wuhan virus, and I will call it the Wuhan virus, is a coronavirus. It's a type of coronavirus. It's very similar to MERS and SARS, and I think it's more similar to SARS than MERS. There is no vaccine for MERS. There is no vaccine for SARS, and the common cold is a coronavirus, and there is no vaccine for the common cold. So the fact that you could just tell me, hey, we're going to come out with a vaccine, a viable, workable vaccine in a matter of months, vetted and purely tested, where people are going to say, hey, let me take it, and it's going to be 100% successful by like the fall, is, I think, asinine. I wish that was not true, because vaccines normally take years to come out. So a viable, provable, effective vaccine probably won't be coming out until 2021, which means the economy is going to stay, for the most part, shut down, which means we're going to go from a depression to a severe recession. Now, I mean, if that's good news to buy stocks, you let me know.
Yeah, that was the thing. I mean, with the unemployment, the numbers coming out, surely people are going to be defaulting on loans. I don't think we're going to see home sales go up, auto sales go up, and you got to wonder with all this bad news, it's a great time to buy stocks, right? I mean, we're seeing the stock market go up.
Well, like I said before, I mean, this is a great time to buy stocks because you're front running the Federal Reserve. So, it was a panic sell. Hey, we are going into a depression. There's, I think it was 30 million people. Is it 30 million people? 1 out of every 5 people, 20%, 30 million people unemployed in this country. And the rapidity of that decline. And you say, well, if I just gave you, Patrick, that piece of information, that GDP is set to decline by, say, 15%, unemployment rate will be 20%, 30 million people unemployed, what would you guess the stock market would be? Would you say that the NASDAQ was up on the year? You would say, if I told you that, you'd say I'm absolutely insane. But when the Fed takes interest rates to 0% and is buying everything, they are buying everything that's not nailed down except for stocks. And then we learned recently that Janet Yellen went before Congress and said, hey, we're probably not going to buy stocks right now, but let's get Congress to change the law of what we could buy now. So we're prepared to buy it in the future. But by the way, let me just say this. In 1913, when the Federal Reserve was established, they were supposed to buy a government debt, so government guaranteed debt, and it was supposed to be given to the discount window at a penalty rate. So they would haircut the assets, and give them some money temporarily on a short-term basis. But that morphed into, through the years, now we're going to buy junk bonds. We're buying junk bond ETFs because we're manipulating every asset on the planet, and we're even taking the 10-year note yield down to 0.6%. So this is the reason why stocks are hot. This is why, and the trenchant, yawning gap between the upper classes and the middle classes, between the stock market and the underlying economy, was huge before this, and now it's enormous and growing.
Okay. Do you think all this money printing and all this buying of everything that the Fed is doing, is it actually going to help or worsen the situation?
Well, there's no free. The way I think about this, Patrick, is there's no free lunch. So for every action, there's an equal and opposite reaction. So if I told you that the uh, the the income of the nation was going to virtually zero, uh, severely attenuated for a quarter, and then you say, well, where's the balance sheet made whole? How is the balance sheet being made whole? So I own a restaurant, and now the restaurant has no income. So you're using me as a conduit to pay through the PPP program, you're paying my employees. So you're giving me a PPP loan and I'm paying my employees and paying my rent. But I still have no income. So where's the income coming from? And here's the income. The balance sheets of the world, not just America, the balance sheets of the world are being destroyed. If you look at the balance sheet of the United States government. So we heard from Stephen Mnuchin today. Actually, it wasn't today. It was like yesterday. And that was my bad impression of Stephen Mnuchin. Okay, Stephen Mnuchin said we're gonna have a deficit of $3 trillion in the second quarter of 2020. That's for one quarter, Patrick. So the balance sheet of the United States government is being destroyed. And I was the first one. I look like an idiot because I said in February, I said the annual deficit for the United States is going to be at least $4 trillion. That's when the CBO said it was going to be 1.5 trillion. Well, how did I know more than the CBO? Because now the CBO says it's going to be $4 trillion. And you can't issue $4 trillion in debt. By the way, so the national debt is 24 trillion right now. So $4 trillion in a year? How are you going to fund that? The only way you fund that is through monetization. So coincidentally, or maybe not so much, the deficit, as I mentioned, for Q2 is $3 trillion, and the Fed's balance sheet is up just about $3 trillion from where it was in January. So are we monetizing all this debt? Absolutely. And you asked a very good question. What's the consequences? Well, normally speaking, if we were a banana republic, our currency would absolutely crater and you'd have hyperinflation. No doubt in my mind, Patrick. This is exactly what would happen. But since everybody's doing it, every currency is collapsing concurrently against precious metals. That's where you'll see the inflation. And unless you get the market, the public, to lose faith in fiat currencies, you're not going to have runaway hyper CPI inflation, consumer price inflation. You'll just have inflation in where? What the Fed's buying. High yield junk bonds, stocks, investment grade bonds. That's where most of the inflation is, where it was in 2008, 2009. Where did all the inflation go, Patrick? The balance sheet went from 800 billion to 4.5 trillion. Where did all the inflation go? Right into the stock market. That's where most of the inflation is going right now.
But Michael, why is the response from the Fed so much bigger now compared to 2008 when the banks have not collapsed, CLOs and derivatives have not blown up, and indebted European countries have not defaulted?
Well, because the speed and rapidity of the collapse has been unmatched. In 2008 was the Great Recession. 2020 is the depression. This is a depression. I'm not happy saying it, but let me tell you, it is a depression when 30 million people become unemployed. It is a depression. That's exactly where we are. So here's the problem. You asked a great question. So let's just say the federal government did nothing. They said or tinkered around the edges, or even did only what they did in 2008. Let's look at pension plans. So the funding rate of pension plans. So they were about 50%. So you look at their assets divided by their obligations, okay? About 50% going into the crisis. Today, they're 20 to 25% funded pension plan, their assets. And then, they had to go out on the risk. You can't make your pension 8% per annum is what you need. Underfunded the pensions. So you need 8% a year just to meet your obligations. You can't get 8% in the bond market. You have to get it in the stock market. So you went way out on the risk curve, buy stocks, and then stocks cratered. So now you're in Illinois, for example, 20% their funding ratio, 20%. So imagine if the Fed let let the stock market collapse. Where would we be? There wouldn't be a solvent pension fund in the United States. And by the way, you're not getting the income either. People aren't paying into their pensions because 30 billion people are unemployed. So if they didn't if they didn't stop that, then you'd have bankrupt pension plans. So they have to try to monetize all of this, the debt, all of the pension plans, blow up the asset bubbles even higher than they were before. And that's the real reason, because you wouldn't have anybody retiring in this country. The question is, can they do it without creating intractable inflation? And that depends on the market's reaction to how much they're burning the dollar. And since everybody's doing it, there's a good argument that says, hey, we're going to get some CPI inflation. But this depends on how often. By the way, that's why this virus is so important, because if the virus doesn't go away, you can think of multiple packages, because Nancy Pelosi wants to now bail out states, right? State municipalities, because they $1 trillion, another $1 trillion. Here we go. So, and where does that money come from? The government doesn't have any money. They have to borrow it. They can't borrow from an insolvent, nation, so they have to have it monetized. So how many iterations of that process? Was it the fourth or fifth stimulus plan coming already? The virus hit in January. We're the fourth or fifth iteration of the stimulus. So how many times can they borrow $1 trillion, or $2 trillion, or $3 trillion, and people still say, you know what? I'm going to go and take my money and buy something, and the producer of that good or service says, you know what? I'll accept the purchasing power of your money. That's cognitive dissonance right there. You're going to get some inflation here, and it all depends on how many times the government has to dilute the dollar.
You touched on something when you mentioned Pelosi. What is the chance or possibility, or even what if states actually do go bankrupt, and then what happens with their pension obligations?
Well, I don't think they will go. I don't think Republicans or Democrats. I don't think. Let me do Stephen Mnuchin again. I don't think Stephen Mnuchin will sit back as a Treasury Secretary and watch Illinois, New Jersey, and California go bankrupt. What are you going to do? Lay off cops and teachers? that's not going to happen. It's not a tenable position. So they're going to continue printing. By the way, we had some inflation data, or deep inflation data. It's actually deflation data. It was the biggest drop in CPI we've ever seen. So we don't have inflation, we don't have disinflation, we have deflation right now. And what does every central bank on the planet want more than anything? What do they want for Christmas? They want 2% inflation. Well, you're not getting 2% inflation, you're getting deflation right now. So in that construct, they're going to say, hey, why would we ever allow a state to go bankrupt? We'll just keep printing money. And that's what I'm talking about. So you keep doing that until you inculcate in the minds of consumers that your fiat currency is losing its purchasing power. It's becoming worthless. Now, that's what happened in Rome. They kept on debasing, taking those base metals out of, silver out of the denarius. And pretty soon you just say, hey, even though Rome, it wasn't an active currency exchange where, the denarii was being exchanged with some other foreign currency. It was like, oh my God, the denarii is collapsing against Chinese currency. No, the individuals, the citizens of Rome, knew that the coins they were using were losing their metallic content, the valuable metallic content. Silver was being replaced by, what was it? Remind me.
Copper.
Silver was being replaced by
copper, bronze.
What?
Copper, bronze, nickel.
Bronze. That's it. Bronze. You got it. Bronze. I'm sorry, I forgot that. So silver is not as is more valuable than bronze, and more valuable than copper. So people said, why am I still working and producing for the same, or accepting the same amount of denarii for the same effort? So that's what I think is going to happen here in the United States and around the world, as a matter of fact.
Okay, you touched on this before about the Fed buying corporate bonds for the first time. Will they then be fully invested in the stock market, someone like a shareholder, and do whatever it takes to prevent a burst? if you're a shareholder in a company and you have control over the market, you're not going to let yourself lose money or bet on a dying company, right?
Well, so this is how they're getting away with doing things that are probably illegal, Patrick. So they create these special purpose vehicles, so like Enron, so the Treasury borrows some money and puts it in this SPV, and the Fed leverages up that money, 10, 20 times, and then buys high yield bonds. Now, just so you understand, so and I did this math myself before I came on your program. The run rate of corporate debt, which was already at 148% of GDP, it was almost 150% of GDP, record high as a percentage of the phony economy. Nominally speaking, it was over $10 trillion, so corporate debt. Never been anywhere near that before. The run rate of the increase on top of that is 25%, a 25% increase in corporate debt. So now the government is on the hook for this, okay? Because they don't want to have they want to dispel the illusion that the Federal Reserve is bankrupt. So, and I don't know why that's so important. The Fed doesn't really have a balance sheet. Who cares about their balance sheet? The Fed can print money ad infinitum. Who cares if they're bankrupt? But for whatever reason, they want to get some semblance of solvency. So they put these treasuries into this SPV, and then the Fed uses that. So now the taxpayer is directly on the hook. They are now investing in high yield junk bonds. And if those bonds go bankrupt, then what happens, right? The treasury's out. They're done. So we lose money, and the taxpayer doesn't want to lose money. They're going to be able, they want to say, hey, we made money on this investment. So they're going to support these high yield bonds. But since I just mentioned that the government debt is on the run rate to increase by 25%, and I would say a high percentage of these high yield companies were already zombies. In other words, they had to issue debt just to pay interest on existing debt, right? So now you've even added to that problem. Now, people are coming. These corporations are issuing junk bonds left and right, even though just a few weeks ago that market was shut down. So you're not improving the solvency condition of these corporations. You're improving the liquidity of these corporations, but you're not making them solvent, right? So I believe that I believe that the government is going to continue to re-liquefy the bond market, both investment grade and high yield, unless and until the economy ever recovers, which probably never will. Because let's just leave you with this thought experiment on this subject. So if you are massively increasing the amount of junk bonds that are issued, and you're pushing down the interest rates as you do it closer and closer to sovereign debt, which is practically zero, when is it a good time for the government to get out of that practice? Do you remember? And please, I want to make sure your audience understands this. The Federal Reserve was cutting rates not because of the Wuhan virus. The Federal Reserve began cutting rates in the summer of 2019. Okay? They cut rates 3 times before anybody heard that Wuhan existed, the Wuhan virus. So they tried to get out. What's my point? The Fed promised that they could get out of the extraordinary money printing and intervention in markets that they did in the Great Recession, and they could not do it. They had to pivot on a dime in the summer when the repo market blew up, summer of 2019, and they cut rates 3 times and went back into QE before the Wuhan virus hit. So what I'm trying to say is that what we've learned is that when the government and central banks abrogate markets, cancel them, annul them, then they own them forever. And that's exactly where we are today.
Yeah, Michael, what happens when Jerome Powell's arm gets tired from cranking that printing press? I mean, what happens when everything they do, let's say, doesn't work? When will we know that we've finally come to the end?
So governments can ameliorate a depression by borrowing money and printing it. That we've learned many, many times through history. you asked the most salient question that you could possibly ask. When that ends is when they finally arrive at their inflation targets. So when the CPI, as measured, actually they don't even use CPI, they use the PCE deflator, core PCE deflator. Basically, it takes out everything from inflation that's going up. So when they finally arrive at that 2%, and then it starts to go higher, 3, 4, 5%, which is what they want. They're on record saying we have to go higher than 2% to make up for all those years we were below 2%, and now we're below zero. So we're gonna keep printing until we get mid-single digits core PCE, personal consumption expenditure deflator, and then that's when the real poop hits the fan, Patrick, because it is at that point there's nothing they can do. You've now inculcated into the minds of investors that the fiat currencies will be losing their purchasing power, prima facie evidenced by the mid-single digit inflation. And you've taken on a tremendous amount of increased debt from an insolvent base, then you've added to that. And you've pushed interest rates down back to zero and below. So now, and this is my mantra. I say this to everybody who interviews me. It is at that point when we're going to have a devastating implosion of the bond market, because either inflation, if they keep printing money, inflation will keep rising, and you'll start seeing investment grade blow up, high yield blow up, even some sovereign debt will start to, the market will start to balk at owning a sovereign bond from an insolvent nation near 0%. It's just the way it is. The inflation is where interest rates go. So they have to either massively increase the amount of printing and manipulation of these rates, which is just going to feed into the inflation frenzy and destroy the market even further, or they can say, okay, we're going to step back. We're going to attenuate our purchases. And if they do that, then the only buyer of a junk bond, which has the narrower spreads to treasuries or whatever sovereign nations that you're measuring against, the least amount of spread is going away. So now you have an insolvent issuer of a junk bond that's borrowing money at 3-4% in an inflation environment of 5%. Where do you think that rate would go? I mean, it would be 20%, 30% in a matter of days, if not hours. So that's when central banks are caught. That's the ultimate trammel for central banks once they achieve their horrific and asinine inflation targets.
Okay. And in view of this, how can people prepare for this storm coming ahead?
Well, I mean, I think you have to take passive management and flush it down the toilet. That's for sure. So if you're a stock investor, you can't just say, well, I'm 60% stocks and 40% bonds, and I'm balanced and diversified and happily ever after. That doesn't work anymore, because when the 10-year note is 0.6%, there's not much room. If the market, let's just say the stock market tanks and we have a secondary breakout of the virus, and you see the stock market tank, we say, well, I'm balanced because I have some bonds. Well, the bonds aren't going to do much for you at all. You're going to go from 0.6% to zero. The return on that is low single digits. So you're not going to be able to protect your assets. You have to be an active investor. So I have a 20-point model called the inflation, deflation, and economic cycle model. So I measure the economy think of how antiquated we are as an industry. Economics and the analysis of stock markets. Instead of just drawing lines on pieces of paper, I've developed 20 robust components to a model that treats the economy, like a science. So like a weather balloon. I'm sending up, instruments that read where we are in the economy. Basically, I wanted to determine, are we inflating? Are we growing? Or are we recessing and deflating? And if you know where the economy is and where it's headed, you can invest appropriately. So in the case of where I think we're headed, if we're headed for a stagflationary environment down the road, then what do you want to own in stagflation? Well, I have a rigorously back-tested portfolio that I think will do well in stagflation. So you want to own energy, you want to own precious metals, and you want to short bonds. That's what you want to do. Okay. And also, I don't think certain stocks will do horrible in that environment too. So that, you have a model where it says, okay, here's where we're headed, and here's what you need to do. But if you can't do that, I mean, my minimum is around 100,000, but you can always subscribe to my podcast called the Midweek Reality Check. That's only $50 a year, $49.99. Or if you don't have you don't have $50, I don't know how you hedge yourself against what's coming. But if you do have some means, you have 100,000. I would definitely buy some physical gold and have in your possession, say around 5% of your assets as a starting point.
What do you think the chances are of the U.S. government, let's say, expropriating gold again, or even nationalizing gold mines or resources or businesses?
I think they tried that once before, and it didn't Roosevelt fooled the government. The government fooled people once in 1933. I don't think it's going to happen again, and people will defend their gold because they know they're going to. The government's going to say, give me your gold. And okay, now you want it back? Well, it's not going to be, whatever it is at the time, $2,000 now. It's going to be $5,000 now. Well, you just devalued my net worth by a whole hell of a lot. So I don't think people will be willingly, unless they're going to go door to door with firearms and taking your gold. I don't worry about that. I really don't, because I think the chances of that are very, very low. People will not willingly part with their gold and realize they're going to get worthless dollars in exchange.
Okay, your 20-point model. Michael, how can we send people your way to find out more about that 20-point model?
So you could call the office here. I can just, my assistant will describe it to you. The office number here is 732-772-9500. You can email me at mpento@pentoport.com, and we'll set up schedule an appointment that you can speak to me. I want to educate you about it. It's basically active management. I want to make money if the market goes down or if the market goes up. So if we're deflating and we're in a depression, I will short the market. If we're in an okay position, we start to grow in a non-inflationary environment, I can do that too. Or if we're stagflating or reach intractable inflation, all those sectors, I have 5 sectors in the spectrum. All those sectors require different types of investment. I mean, do you want to overweight, for example, do you want to overweight treasury bonds in stagflation? The answer is no. Do you want to overweight treasury bonds in deflation? The answer is yes. So knowing where you are, where you're headed, helps you appropriately allocate your resources. The website is www.pentoport.com.
Okay, Michael Pento, we will surely send people your way, and we thank you for your time. I know you're a busy guy. You got about 50 more channels to get up to.
Thank you for having me on, Patrick. I appreciate it.
That was Michael Pento, president and founder of Pento Portfolio Strategies. For more of the information of his work and his views on the economy, please visit his website, pentoport.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.